Hello and welcome everyone to the first episode of DayPriest Investor Podcast. I'm Dayan here. This is the English version of my Persian podcast named Along the Investment Market. In this podcast, we will talk about the true mindset of investing, and I'll be sharing the lessons I've learned, the mistakes I've made, and the journey I've taken while building my personal investment portfolio. In this episode, we are tackling one of the most important questions in investing. Why do so many people fail at investing? This episode is heavily inspired by a fantastic book, The Psychology of Money by Morgan Housel. It's one of the greatest books I've read recently, and I strongly recommend it to anyone, even if you're not into finance yet. One simple yet powerful quote from the book says, "Financial success is more about behavior than intelligence." That line hits hard. It means you don't need to be genius to build wealth. What matters more is how you behave, your patience, your emotional control, your consistency. That's what sets you apart in the long run. Warren Buffett, one of the greatest investors of all time, has famously said, "If you have an IQ of 150, give 30 points away. You won't need it. 120 is plenty." Actually, he's not joking. Investing doesn't require extraordinary intelligence. It requires temperament, risk management, discipline, and the ability to stay calm. What do we mean by behavior? Let me give you some examples. When the market is booming and everyone is euphoric, don't get carried away and rush into risky trades. When the market crashes and fear spreads like wildfire, don't panic and make impulsive decisions. I've made these mistakes myself more than once, but I try to learn from them every time. Three common mistakes in investing. Mistake number one, chasing fast profits. A lot of people enter the market expecting to double or triple their money in just a few weeks. They throw money into trendy cryptocurrency or rumor driven stocks. Then, after their first major loss, they give up entirely. Once a friend told me, "If I give you 1,000 euros, can you turn it into 100,000?" I just smiled and said, "Come on, that's even hard for the greatest investors, especially in short period of time." Their mindset is completely wrong about what investing really is. They mistake it for gambling on shitcoins in crypto or even high leverage forex trades with 100x or even 1000x leverage. It's not investing, it's speculation masked as a strategy. Look, I've done it too, I don't ignore it, but we need to understand the risk involved. Chasing quick money often leads to quicker regrets. Mistake number two is trying to predict the market. Many people think they can buy at the bottom and sell at the top. Even professionals can time the market perfectly. If that were possible, the world would be full of trillionaires. Instead, focus on solid strategies like fundamental or technical analysis and invest consistently. Mistake number three is believing you need a lot of money to start. You don't. You can begin with small amounts as long as you're consistent. This is where the compound effect comes in. The idea that small amounts invested regularly can snowball over time into serious wealth. Compound growth is like a snowball rolling downhill. It starts small, but with enough time, it becomes massive. Just make sure that the money you invest is not something you will need in the next 5 to 10 years. The right mindset for long term investors. Don't just see yourself as a trader. Think like a business partner. When you buy a stock, you're buying a piece of a real company. Give your investments time. Investing is like planting a tree. The longer it grows, the more fruitful it becomes. Tune out the market noise. The market is full of noise, rumors, hype, and fear. Stay focused on your strategy. What's the role of luck in investing? Morgan Housel reminds us that even the most successful people had luck on their side. Warren Buffett famously said, "The biggest luck in my life was being born in the United States." So if you succeed, stay humble. And if you fail, don't blame only yourself. Now, What's the difference between getting rich and staying rich? Some people get rich once but lose it all again. They take on too much leverage or chase risky bets without thinking. Rick Gorin, Buffett's friend, was very successful in the 60s and 70s, but he lost everything because he over leveraged. Warren Buffett and Munger, on the other hand, played it cautiously and patiently. That's why they are still around and winning, and of course Munger till end of his life. And now, final takeaway. There's a powerful quote from the book Market Wizards that perfectly sums up the mindset every investor should have. If you don't bet, you cannot win. But if you lose all your chips, you cannot bet. In other words, you need to take risks to win, but you also need to manage those risks wisely. If fear stops you from acting, you will miss every opportunity. But if you take reckless bets and blow up your capital, you won't be able to participate again. Smart investing isn't about avoiding risk, it's about understanding your limits and staying in the game long enough for your strategy and discipline to pay off. So take risks, but the kind that won't take you out of game. If you found this episode helpful, follow us on YouTube, Spotify, or Apple Podcasts and share it with others who might benefit. Don't forget to like and comment. Until next time, stay calm, stay aware, and let your money work for you.